Meet Tom and Carol from Wisconsin. Tom just retired at 64. Carol is 62. They worked hard for 35 years. They saved well. They have $850,000 sitting in a traditional IRA. And one evening, Tom finds a video online. The title says, "Convert $1 million to a Roth IRA and pay 0 taxes." Tom watches the whole thing. He gets excited. He calls Carol in. They write down the steps. Then they read the fine print. The strategy requires $440,000 in extra cash, money they don't have. It requires investing in a real estate development deal that drops 40% in value on purpose. And it involves oil and gas wells that, based on what real investors say, most people never see a dime from. Tom closes the laptop. He feels frustrated, maybe a little foolish. He wonders, is there actually a smart way to do this without the risky schemes? There is. By the end of this video, you will know exactly how everyday retirees legally reduce taxes on a Roth conversion. You will know when the best window is. You will know how much to convert each year. And you will know 3 hidden costs that most other videos never mention. Quick note before we start. I am not a financial advisor or a government employee. Everything in this video is for educational purposes only. For your specific situation, always work with a qualified tax professional. Now, here is the part most people miss. You may already be sitting in the lowest tax window of your entire adult life right now. And that window closes the moment Social Security and required minimum distributions kick in. I'll show you exactly what that window looks like and how to use it. Part 1. The required minimum distribution time bomb. Here is what most people do not think about when they look at their IRA balance. Let's say you have $800,000 sitting in a traditional IRA. That money feels safe. It feels like yours. But at age 73, the IRS has a rule. It's called a required minimum distribution, RMD for short. The rule says you must start taking money out, whether you want to or not. On an $800,000 balance, your RMD at age 73 is roughly $30,000. That's added to your taxable income, whether you need it or not. By age 80, the same account, if it is kept growing, could force out $50,000 or more every single year, taxed as ordinary income. But here's where it gets worse. That forced income doesn't just cost you income tax. It can make up to 85% of your Social Security taxable, too. Here's the myth. Social Security isn't taxed. Here's the truth. Once your income from all sources, including IRA withdrawals, exceeds a certain threshold, up to 85% of your Social Security benefits can become taxable. And that threshold has not been adjusted for inflation since 1993. Think about Tom and Carol. They expect $40,000 a year in combined Social Security. Without any IRA income, most of that could be completely tax-free. But add a $40,000 RMD on top, and now the IRS treats that combined income as your total. Suddenly, up to $34,000 of their Social Security becomes taxable every year for the rest of their retirement. Financial planners call this the tax torpedo. It's when adding $1 of IRA income causes even more of your Social Security to get taxed, pushing your real effective tax rate far above what your bracket suggests on paper. A Roth IRA has no required minimum distributions. None. You are never forced to take money out. The money grows completely tax-free for as long as you live. No RMD at 73, no RMD at 80, no RMD at 90. And when you pass it on to your children, they can keep growing it tax-free for up to 10 more years. So a Roth conversion is not really about today. It is about what happens at 73, 75, 80. That is when a traditional IRA becomes very expensive to own. So now you know why this matters, but here's the real question. When is the best time to convert? because the window is shorter than most people realize. Here's what I mean. Part 2. The golden window, the gap years strategy. There's a period in many retirees' lives that most financial videos completely ignore. Planners call it the gap years. Here's what that means. It's the time between when you stop working and when Social Security payments and required minimum distributions begin. For many people, that window runs from roughly age 60 to age 72. During the gap years, your income often drops to near zero. No salary, Social Security hasn't started, no RMDs yet. Your taxable income could be the lowest it's been since your 20s. That's the window. And here's why it matters so much right now. In 2025, the U.S. tax code introduced an enhanced senior deduction for people age 65 and older. Combined with the standard deduction, a married couple where both spouses are 65 or older can deduct up to $46,700 from their income before paying a single dollar of federal income tax. Zero. And if they want to convert more, if they want to convert $130,000 to $143,000 in a single year, they can do that and stay entirely within the 12% federal tax bracket. On $143,000 converted, their total federal tax bill would be roughly $10,000. That's an effective rate of about 7%. Compare that to the 22, 24, or even 32% bracket they'll likely face when those same dollars are forced out as required minimum distributions later, on top of Social Security income. Tom and Carol have roughly 8 to 10 years in this gap window before their RMDs begin at 73. If they convert $130,000 a year for 8 years, they can move over $1 million into tax-free Roth accounts at an average effective federal rate of less than 10%. No oil wells, no apartment construction deals, no $440,000 in extra cash required. Just a clear plan, a tax bracket, and a window of time. The key insight is this: the gap years only come once. Once RMDs begin, forced taxable income rises. Once Social Security starts, even more income can be taxed. The window closes permanently. So how much should you actually convert each year? There's a specific number for everyone. Let me walk you through exactly how to find yours.
This strategy has a name among tax planners. It's called bracket filling. Here's how it works. Every year, the IRS has tax brackets, ranges of income taxed at different rates: the 10% bracket, the 12% bracket, the 22% bracket. The goal is to fill those lower brackets with your Roth conversion each year without spilling into the next, higher one. Here's the myth: you have to convert everything at once or not at all. Here's the truth: you can convert any amount you choose: $5,000, $50,000, $143,000, as little or as much as your tax bracket allows. You decide. The IRS does not force the timing. That control is yours. Here's how to calculate your number. 3 steps. Step 1. Start with the top of the tax bracket you want to stay in. For most gap year retirees, that's the 22% bracket. In 2025, for a married couple filing jointly, that tops out at $206,700 in taxable income. Step 2. Subtract your standard deduction. For a married couple where both spouses are 65 or older in 2025, that deduction is up to $46,700. That means your first $46,700 in converted dollars faces zero federal tax. Step 3. Subtract any other income you already have: a part-time job, dividends from a taxable brokerage account, pension income. Subtract all of it from that $206,700 ceiling. What's left? That's your conversion sweet spot for this year. For Tom and Carol, both 65 in their gap years with no Social Security and no other income yet, the math is clean. They can convert up to $143,000 and stay inside the 12% bracket. Federal tax, roughly $10,000. Effective rate, about 7%. Do that for 8 years, and the bulk of their $850,000 traditional IRA is now inside a Roth, compounding tax-free forever. One important rule before you start: if you're already 73 or older, the IRS requires you to take your required minimum distribution first. You cannot convert your RMD into a Roth. Take the RMD out first, then do the conversion on top. And here's a practical tip most videos skip over. When you do a Roth conversion, do not withhold taxes from the converted amount. Every dollar withheld shrinks your Roth balance permanently and never grows tax-free. Instead, pay the tax bill from a separate savings or checking account. That way, the full converted amount goes straight to work for you, untouched. Now you know the strategy, the gap years, the bracket math, the 3 steps. But here's where I need to slow down, because there are 3 hidden costs that can quietly wipe out the benefit of a conversion if you're not watching for them. None other videos cover all 3. This is the part most people miss. You now have the core strategy, but before you act on it, there are 3 hidden costs that can catch you completely off guard. None of them disqualify a Roth conversion, but all 3 can change your math significantly if you miss them. Trap number 1, IRMAA. That stands for Income-Related Monthly Adjustment Amount. It's an extra surcharge on your Medicare premiums. And the part that catches people off guard is this: Medicare uses your income from 2 years ago to calculate it. So a large Roth conversion in 2025 shows up on your Medicare bill in 2027. For 2026, a single person with income above $106,000 starts paying IRMAA surcharges. For a married couple, the threshold is $212,000. Exceed those thresholds by even $1, and you jump to the next tier, potentially adding $1,400 to $5,600 per year in extra Medicare costs per couple. Before doing a large conversion, check whether you're close to an IRMAA threshold. A slightly smaller conversion that keeps you under the line could save more than the conversion saves in taxes. Trap number 2, the ACA subsidy cliff. This one only applies if you're retired and under 65, meaning you're not yet on Medicare and you buy health insurance through the ACA marketplace. In 2026, premium subsidies phase out once your household income crosses 400% of the federal poverty level. For a couple, that's roughly $84,600. A Roth conversion that pushes your income even $1 over that line can eliminate thousands of dollars in annual health insurance subsidies in a single move. For some early retirees, losing those subsidies costs more than the taxes saved on the conversion. If you're between age 60 and 64 and relying on ACA marketplace health insurance, talk to a tax professional before converting anything. Before I show you trap number 3, drop a comment right now. Are you already collecting Social Security, or are you still in the planning window before it starts? I read every single comment, and your answer actually matters because it changes which part of this strategy applies most to you. Trap number 3 is state income taxes. Almost every Roth conversion video you'll ever watch only shows you the federal tax numbers, but 41 states levy income taxes on top of that. Converting $100,000 in California can add 9 to 13% in state taxes on top of your federal bill. That changes the math significantly. Some states offer partial or full exemptions for retirement income. Some states have no income tax at all. Check your specific state's rules before assuming the federal rate is your only cost. These 3 traps don't make a Roth conversion a bad idea. They make an unplanned Roth conversion a bad idea. Smart retirees account for them before they pull the trigger. Now you can. So, you've done the conversion, the money's in the Roth. Now, what do you actually do with it? Because where you put that money inside the Roth is almost as important as the conversion itself. A Roth IRA is the best account in the entire tax code for one specific investing strategy: dividend income. Here's why. In a regular brokerage account, every dividend you receive triggers a tax event. Even if you reinvest it immediately, the IRS takes a cut, year after year. That tax drag quietly shrinks your compounding. Inside a Roth IRA, there's no tax on dividends. Not when they're paid out, not when they're reinvested, not when you eventually withdraw them. They compound completely untouched. Here's a concrete example. SCHD is the Schwab U.S. Dividend Equity ETF. It holds 100 high-quality U.S. companies with strong dividend histories. It currently yields roughly 3 to 4% annually, and it's grown its dividend at about 10% per year over the past decade. Put $200,000 in SCHD inside a Roth IRA at a 4% yield that pays approximately $8,000 per year in tax-free dividends today. In 10 years, if dividends keep growing at that historical rate, that same position could generate over $20,000 per year in tax-free income, without adding a single dollar, without touching the principal. In a traditional IRA, the same dividends exist, the same growth happens, but every withdrawal is taxed as ordinary income. The Roth version of the same investment produces meaningfully more after-tax income every year for the rest of your life, and your beneficiaries can continue growing it tax-free for up to 10 more years after that. Tom and Carol understand this now. They're not trying to find a scheme to pay zero taxes. They're doing something better. They're paying taxes on their terms at 7% now, instead of the IRS's terms at 22% later. That's what a smart Roth conversion does. It replaces forced, uncontrolled taxes at age 73 with planned taxes during the gap years. It turns a traditional IRA into a tax-free income machine, and it does it without risky investments, without oil wells, and without $440,000 in extra cash. If you know someone approaching retirement who's worried about the taxes buried inside their IRA, share this video with them right now. It could genuinely change what they do next. And drop a comment below. How many years do you think you have left in your gap window before Social Security and required minimum distributions start? I want to know where you are in the process. If you're building retirement income and want to stay ahead of changes like this, subscribe to Dividend Hustle. I cover the strategies that protect your income, grow your dividends, and help you keep more of what you've earned.